The euro retreated mildly, following mild risk aversion as Google and Microsoft's earning reports triggered some sell-off in U.S. equities. EU Economic and Monetary Affairs Commissioner Olli Rehn said that the framework of the banking union would be completed by the end of this year, and the entire banking supervision mechanism will become a reality on January 1, 2014. Rehn emphasized that the agreement was vital to break the vicious circle between sovereigns and banks. Under the mechanism, leaders have agreed that all 6,000 banks inside the Eurozone would come under European Central Bank supervision, with day-to-day oversight delegated to national authorities. The ECB would be responsible for the supervision of only the systemically important banks, and oversee others when necessary. A question, though, is when the European Stability Mechanism could start recapitalizing troubled banks, as France thought it could start as early as 2013, but Germany thought it would not happen as soon. Meanwhile, the issue of Spain's bailout request was not discussed yesterday. The Canadian dollar was shot down again by officials' comments. Finance Minister Jim Flaherty said that while Canada is still on track, the economists have told them to anticipate moderate growth, and the economic forecasts may have to be revised downwards. This added to dovish comments from Bank of Canada Governor Carney earlier this week, as he warned that synchronous slowdown underway in the global economy could spill over into Canada. The bank's revised forecast next week will take into account the impact of the uncertainty. These comments suggest that the bank will turn from a mildly hawkish stance to neutral in next week's post-meeting statement. On the data front, Japan's all-industry activity index rose 0.1% month-on-month in August. German PPI accelerated to 1.7% year-on-year in September. UK public sector net borrowing is the main focus in the European session and is expected to be at £11 billion in September. Canadian CPI will be the major focus in the US session based on recent volatility and the sentiments towards the Canadian dollar. CPI is expected to be unchanged at 1.2% year-on-year, while CPI is expected to slow to 1.5% year-on-year. A weaker-than-expected inflation reading could trigger another round of sell-off. U.S. existing home sales are expected to drop to a 4.7 million annualized rate in September.